Hello, everybody, and welcome back. I'm Brady Ryan, manager at CoMotion Labs, and we're back with part 2 of our hardware series. If you were here last week, thanks for coming back. If not, we have the video. You can watch it. It was great. But we just hope you like the series. So CoMotion Labs is University of Washington's multi-industry incubation environment for Seattle and UW's innovation community. We provide critical infrastructure like desks, wet lab space, and prototyping space, as well as critical education, mentoring, and networking for our startups. I like to think of it as the best version of co-working available, where we do everything we can to support early stage startups. We don't take equity and we don't take any sort of IP position. We really just exist to provide co-working and incubation for the best startups in Seattle. You've probably heard of 2 of our spaces, Startup Hall, which focuses on software and IT, and Fluke Hall, which has traditionally focused on life sciences and biotech. Excited to announce that we've just opened a 3rd space focused on hardware startups. We heard from the community that hardware startups need more love and resources in Seattle, and we were happy to jump in. So what does co-working at Hardware Hall look like? We rent both desks for all your programming and bookkeeping, and workbenches for prototyping and wrenching on whatever you're working on. We have shared equipment like a suite of 3D printers, SLA printers, laser cutter, entire circuitry rework area. We have conference rooms, phone booths, coffee, all that. And we also have connections to a bunch of machine shops on campus where you can get things done. And we're building a lot of relationships with service providers and design shops across the region. We do what we can to help you raise money and prototype and learn what you need to learn to find the right mentors. So we had our soft opening on Monday, which I'm so excited about. Finally have a startup in the space and brought on our very first company. And we're going to be bringing on another one on Friday, and then slowly adding companies here and there until we feel comfortable that we can navigate COVID safely, but still get some companies into work. So this is the new venture we're on, supporting hardware startups. And I'm brand new to hardware, so I'd love to hear from anybody who knows hardware, hear your thoughts, figure out how we can make this place as useful as possible. We have a lot of decisions to make and a lot of directions to explore, and your perspective would be extremely valuable. My email will be available. It'll be in the chat as well as on screen, and I'll look forward to hearing from all of you. Next, I'd like to introduce Harinderpal Hanspal, or Hans to his friends. He's the leader of a fantastic meetup group called the IOT Hub, and he is as well networked in the space and as helpful as pretty much anybody I've met. So if you don't know Hans, do yourself a favor and reach out. Hans, over to you.
Thank you, Brady. As Brady mentioned, I lead the Seattle-based IoT Hub meetup group. We're a community of technologists, entrepreneurs, corporate innovators. We have a lot of industry experts who've been trying to reach out to many of the manufacturing and industrial companies here locally. And we also have a lot of executives and students who want to connect, share, learn how IoT and Industry 4.0 type technologies are going to shape our lives, communities, jobs, and industries. The group's been around for 4.5 years. We just passed 3,800 members. And our members represent technology, industrial, and manufacturing companies. As I mentioned, many of them are local, Seattle-based. And they range from startups to big global industrial companies, many of which we all recognize. Our meetups cover technology topics with all the usual IoT buzzwords: edge computing, 5G, edge to cloud, digital twins, and of course, security. To understand how things will shape industries and jobs, we devote time to industrial IoT and Industry 4.0 topics, focused around things like manufacturing, intelligent maintenance, and field service, robotics and industrial automation. We just started a series around that, and also looking at business models like hardware today. We have many members in our meetup group who have to build some kind of connected widget. And last year, we decided to start a series on to help connected hardware startups. Just some interesting data around this. Last year, according to Bloomberg, 43% of all VC investments went into hardware, which was surprising. But the other bit of data from CB Insights is that only 24% of hardware startups made it to their second round. That compares with, I think, is 46% for all tech companies. And then 97% of them fail altogether, again, comparing to tech companies, which are at 70%. So it doesn't look good for hardware entrepreneurs. And the startup ecosystem here in Seattle for hardware startups is virtually non-existent. To help address this, we've started these set of meetups, and I'm very excited that CoMotion Labs decided to get into hardware as well, and partnering with Brady and Caroline to hopefully help build an ecosystem here in Seattle that's as deep and wide as our software ecosystem. With that, I'll hand it back to Brady.
Great. Thank you so much. Some final announcements before we get started. Next Wednesday, Scott Heimendinger, who is an entrepreneur and inventor working at the intersection of food and technology, will present how to start prototyping your next smart hardware product. Please register for that and join us there. All of our fundamentals for hardware startups presentations are archived on YouTube. If you go to the CoMotion website under labs/startup training videos, you can find them there as well. Throughout our various speaker series, we have covered a variety of topics over the last several years. And so if you find yourself with some free time, check them out. For our full schedule and to register for future events, you can visit comotion.uw.edu/events, which will be up on the screen. And with that, today, Chrissy Meyer is here to present business models for hardware companies, an investor's perspective. Chrissy has spent the last decade taking hardware products from early concept through high volume production. After getting her MS in electrical engineering from Stanford, she led several projects at Apple and Square. She's also a founding team member at Pearl Automation, a vehicle technology startup. She has developed products that have shipped tens of millions of units, and she spent over a year on the ground in Asia working closely with manufacturers and suppliers. Chrissy is currently a partner at Root Ventures, a seed stage hard tech venture capital firm. At Root, she invests in deeply technical teams that are solving problems in robotics, hardware, and industrial automation, AI, and machine learning. I'm just super excited that we have an actual hardware investor. Apparently there's not that many around, so thank you, Chrissy. Chrissy will take questions via chat or email. That info is on the screen as well. Feel free to ask questions throughout the presentation, and I will now turn the event over to Chrissy.
Well, thank you so much, Brady. I am a huge hardware nerd, huge hardware nerd. So I am so excited to see you guys doing this type of programming. I feel like a lot of generic startup and engineering advice that's floating around out there just flat out does not apply when you're dealing with physical products. Hardware is a very special case. So I'm excited to see you guys putting together a speaker series focused on it. But before I get started and dive into the meat of the presentation, I will give just like a quick 2-minute version of my background and where I'm coming from. And then I'll give a little bit more context on the type of investments and what we do at Root to give people a better idea of where I'm coming from. So as Brady mentioned, my background is all in electrical engineering. I moved out to San Francisco, so I'm based in the Bay Area, traveled to Seattle quite a bit because we've got a couple of companies that we've invested in, one out of UW actually, but still based in San Francisco. I did my master's out here at Stanford, and then since then, I've worked on everything from military satellite systems to iPods to the very first Apple Watch program. I was at Apple for, it was probably about 6 years. So I obviously did the big company thing, but I also did the super early stage startup thing as well, where you're a handful of friends working in a garage for months without pay. And I've shipped consumer products, like I've shipped products that have sold like extremely high volume, tens of millions of products in a quarter. And then I've sold like enterprise hardware as well, where you're shipping like hundreds in a quarter. Very different beasts and very different companies. So I've seen a lot, but the common theme through like my entire career is that I've always touched hardware. I get such a adrenaline rush from building something that you can touch and feel and like physically holding your hands. I'm guessing most people watching today probably understand exactly how I feel and get that same adrenaline rush too. So a few years ago, I shifted into an investing role. I shifted away from operating roles and into a investing role. And I joined a seed stage venture capital firm in San Francisco called Root Ventures. And this is basically a list of some of the companies that we've invested in. And when I say seed stage, what I mean is that we invest at like the earliest stages of a company. So a lot of times it will be, 2 or 3 co-founders and an idea. A lot of times there is like no working prototype, there's no fancy demo, there's no polished cosmetic mock-up. A lot of times we are literally investing in a team and a dream. So we do invest in a lot of hardware companies. Like a lot of the companies on this list do hardware in some way, shape, or form. And obviously like that's my area of focus and what I like to look at. But we also invest in a lot of pure software companies too. So there's a lot of companies on this list that like don't do hardware at all. So to give you an idea of the types of things that we like to invest in, everything is deeply technical, regardless of whether it's hardware or software or both. And we've invested in everything from companies building hamburger making robots to machine learning for manufacturing lines to sustainable seafood, lab grown seafood. It's a really fun mix of companies. And I think my favorite part of it all is that when you invest in companies this early, you really get the chance to roll up your sleeves and help. Like they're scrappy. They don't have a lot in terms of money and team and resources. So it's a fun chance for me to still get to tap into my like hardware operating roots and help them as much as I possibly can to get a product shipped and get a product out the door. So enough about me. So I'll dive into the material. So what I want to talk about today is I'm going to talk a little bit about hardware business models and how hardware companies can build up business models around the products that they're making. John's talk last week was spot on, and I really like the way that he kind of broke out the different phases of developing a product. But I want to take it a step further and say, okay, now that you've developed a product, now that you've built something, like how do you make money? Like, fundamentally, how am I going to make money off of this? How am I going to turn this from a cool product into a real business? There's a few different ways you can break it out, but I'm going to talk about, I like to break it into 4 main buckets, and I'm going to talk about these 4 main categories today. And they're pure hardware plus consumables, hardware plus services, and then hardware as a service, which those last 2, it sounds similar, but the last 2 are actually quite different in terms of business model. So I'll get into that later. As I walk through, I'm going to give examples both on the consumer product side and on the enterprise side, and show a couple of companies and products that fit into each of these categories. And then I will do my best to leave time at the end to talk about what is appealing to investors and why it's appealing to investors. So the high level there is that there are a lot of ways you can finance your business and raise money without ever taking a single dollar from a venture capitalist. It is not a requirement. But if you do want to go out and pitch VCs, if you do want to go out and get investors to invest in your company, I want to make sure that it's clearly outlined, like what business models are attractive to us, how we like to look at it, and why, so that can hopefully help people position their company. So the first one I'm going to talk about, the first category is pure hardware, and this is the simplest, most obvious, like most traditional form of business model. It is very simply, I give you a product, you give me money. that's it. That's literally all there is to it. We like to talk about revenue. We like to talk a lot about revenue, and we call this non-recurring revenue, meaning it happens once. So all the money that I make comes from the sale of the product itself. I get all that money at the time that I sell the product. I get paid all at once. The transaction is done. Like, that's it. I do not get paid again. In terms of examples, it's pretty much anything that you like, anything that you buy off the shelf at Target, or almost anything that you can buy off the shelf at Target. It's the chair that I'm sitting in, the shirt that I'm wearing, the shoes on my feet, like almost everything is pure hardware. But there are two things, like when we talk about hardware companies and we talk about hardware business models, there are two terms that I kind of want to define up front that I think are helpful to think about things from the perspective of. One is revenue streams. So revenue stream is basically just saying different ways to make money. So the more revenue streams I have, the more different ways I have to make money. Pure hardware is kind of an interesting beast, because in order to introduce a new revenue stream into my business, if I'm operating a pure hardware company, I need to design and develop and build a new product. So additional revenue streams come from additional products, and it takes time. Like, designing and developing a new product takes time, and it takes capital, it takes money. So it can be very expensive, and it can take a long period of time in order to introduce new revenue streams in this particular business model. The other term that I think is important to define is LTV. LTV is a metric that indicates a customer's lifetime value. The basic definition there is just how much money am I getting from a customer over the entire span, their entire lifespan. In the case of a pure hardware business model, the LTV of a customer, the lifetime value of a customer, is just simply the cost of the product. Like, they buy the product once, they pay me for it, that's it. They're not obligated to pay me anything else. So the entire LTV is just derived from the cost of the product. So a few really important things that I think are worth highlighting when you're talking about a pure hardware business model, and things to consider if you're building a company around this. First is that gross margin matters a lot. So gross margin is the profit that I make per product I sell. Like, how much money do I get to pocket? If I'm selling a product for $300, at the end of the day, am I keeping and pocketing half of that? Am I pocketing $150 of that $300? Am I pocketing more? Am I pocketing less? Like, that percentage is your gross margin. Gross margin becomes incredibly important when hardware is your only revenue stream. When you're operating a pure hardware business, gross margin matters a lot. That is the entire way that you're making your money. Also, another important thing to consider is sales and distribution channels. How are you going to sell your product? If I'm selling direct through my website, that's great. But if I intend to sell my product through retail stores, even Amazon, they will take a very large cut. They will take, anywhere from 15% to I've seen north of 50% of the sales price of your product, the retailer will take, and that eats into your gross margin. You will take home less per product that you sell, significantly less per product that you sell. And since gross margin is so important in this business model, it can really hurt you. Other risks with pure hardware businesses are how not to become a commodity. Like, how do you prevent, like, you ship a product, how are you going to prevent dozens of other companies from seeing your product and then popping up with, like, variations of it, or effectively knockoffs in some way, shape, or form? And with pure hardware businesses, it's important to realize that it's often more about setting up a really, really strong brand and setting up really strong distribution and sales and marketing channels than it is about any IP or having a special patent or any kind of strong technical advantage. So another way to kind of look at it and think about pure hardware businesses is to look at it from the perspective of like revenue over time, or in this case, like I've charted out what it looks like to see revenue over the number of devices sold. And it's very simple. It's a line, it's linear. It's like the amount of revenue that you get, that your company will get, will scale linearly with the number of devices sold. So basically that just means that in order for me to make another dollar, I have to sell another device. It's really as simple as that. So jumping into the second category, the second main bucket that I want to talk about is what I call consumables. And you'll hear me use the word like refills, replacements, consumables, cartridges, pods. Like I use them interchangeably in this case. So just kind of bear with me here. But the general idea is that I'm selling a device, I'm selling a hardware device, and I'm collecting initial money from the sale of the device, but my device will not continue to work unless you purchase some sort of like physical refill or physical replacement for the device. So this is nice because as investors, we think of consumables as another revenue stream. So now you have multiple revenue streams, like out of the gate. You have revenue from the device itself, and then you have revenue from the consumables and the pods. After you sell the device, you will keep getting money indefinitely into the future from the customer, from your sale of the consumables, as long as that customer is continuing to use your product. Like as long as they keep using your product, you're gonna keep getting money from them. In this particular business model, I feel like gross margin matters less. Gross margin of the device matters a lot less, the initial hardware device. Often you will see companies that are doing this sell their product at a loss or sell their product at like break even or very, very close to break even. And they can do that. They can afford to do that because generally the margins on the consumables are much, much, much higher. So even if I sell my main product at a slight loss, it's okay because I know and I'm confident that over time, I will more than make that money up by selling the pods or the consumables. So the classic example of this that like everybody likes to talk about is Keurig, obviously. Keurig and their coffee pods. Joule is another one. Joule, I can guarantee you, I can almost certainly state that they are losing money on the device itself. They're probably the packaging is probably worth more than what they sell the device itself for. But they more than make up for that on the pods, like more than make up for that on the pods. And it's a similar situation with like, people talk about razor blade models. It's the same thing. I don't know if anybody has the Quip toothbrush. Like it's the same thing. They're banking on you buying the toothpaste. Printers are the other like really classic example. And that includes like your traditional printers where you're buying ink cartridges. That also includes your 3D printers where you're buying these like massive spools of filament. The idea is that they're continuing to make money on the consumable over time. Now, what makes this business model tricky or what makes it kind of hard is figuring out pricing can be difficult. So there's some strategy around figuring out how much you should charge for your device versus how much you should charge for the pods or the refills. And that can be tough. Like sometimes you might want to charge a little bit more for the device and a little bit less for the pods, or a little bit less for the device and a little bit more for the pods. And different customers have different sensitivities around that. So figuring out what the right balance is and how to strike that balance can be kind of painful. I actually have one portfolio company that we invested in that's going through that exercise right now. They're trying to figure out what the right balance is between charging money for the device and charging money for the pods. Another thing that's kind of crazy about this particular business model that a lot of people don't immediately think of is that supply chain complexity goes up pretty significantly. So very, very, very often you have two entirely different supply chains for your device, your main device, and your consumables. They're, think about the coffee maker and the coffee pods. Like, they're fundamentally very, very, very different products. And you've got different suppliers and different manufacturers making them, probably in different parts of the world, like totally different parts of the world. And one is going to be pretty low volume, one is going to be very, very, very high volume. So now you're having to juggle two entirely different sets of manufacturers and suppliers, and that's just more overhead. It's just more overhead. It takes more people to manage all of that and coordination to keep them in sync. Another thing with this business model is you have to really think through, like, how do I prevent third-party players from making their own version of my pod? How do I prevent them from making their own refills that will work with my device? Because that fundamentally that cuts into my revenue, which is not great for me. There are some things that you can do. You can get clever. I've seen people put little NFC tags in their replacement cartridges, and then you can authenticate the pod and identify it. Your device can identify it and say, like, yes, this is a first party pod. This is something that I made, and reject anything that doesn't authenticate in that way. But customers often react poorly to that. They don't always like being locked into purchasing first party refills. Consumers like choices, and they don't always like being locked into a certain brand. So you might get some pushback on that. And if your brand is strong enough, maybe you just flat out don't care. Like, maybe it doesn't matter. I feel like Keurig is still an interesting example here, because even though there are tons of alternatives, there's so many different brands that you can buy of pods that are not Keurig branded. Still 60% of people who own Keurigs are buying Keurig branded pods, even though they're significantly more expensive, and you spend a lot more money on them, and that's because Keurig has built such a strong brand. There's just a lot of brand loyalty there. And then the last thing to think about here is sustainability. Like, there's been a big push in recent years for companies to pay a lot more attention to sustainability and to environmental causes. And by nature, a lot of these consumables generate excess waste. There's not always a great recycling story, and they're not always easy to recycle. So you've got to have a clear story around how you're going to deal with that. Cool. So this kind of takes a look at it from what it looks like from a revenue perspective, and I'm going to call this piecewise linear. Initially, most of your revenue is going to come from device sales, but over time, it's going to start to shift, and you're going to see a larger and larger portion of your revenue coming from the consumables themselves. Ultimately, it's a situation where you still have to manufacture and sell another thing, like another physical product, in order to collect another dollar from your customer. So in that way, it's very similar to pure hardware business models, but the customer lifetime value, the customer LTV is so much better in this case, so much better, because I can continue to collect more money from my customers as long as they keep using my device. It makes it a much more attractive business model. Okay. So the next one I'm going to talk about, sorry, I'm just lost my slides here for a second. Hope you guys can still see that. So the next one I'm going to talk about is services. So hardware plus services is probably one of the most, oh, can you guys still see me? Yes. Okay. Hardware plus services is probably one of the most popular business models today. People call this different things. So sometimes you'll hear people say hardware enabled services. Sometimes you'll hear people say hardware enabled software, hardware enabled SaaS. Like you can call it a million different things. Call it whatever you want. But the idea is that now that more and more devices are being connected, now that more devices have, you know, cellular radios and Wi-Fi and Bluetooth embedded in them, there's now an opportunity. It creates this huge opportunity to sell the device and get non-recurring revenue from that, and then also sell a subscription for it, and sell it in a way that you can continue to collect recurring revenue on an ongoing basis, even long after you've shipped the device. Sometimes these devices have basic functionality that they support. So even if you don't pay a subscription fee, like it'll still do something. Sometimes they don't. Sometimes if you don't pay the subscription fee, the device doesn't work at all. Like it just flat out doesn't work. The thing that makes this interesting is that now I have revenue streams that do not depend on selling a physical item. The fact is that now you're selling services and you're selling software features. So I can sell a product to you today and then make it do like totally different, new, better things in the future. And I can continue to capture more value and capture more money from my customers that way. So the most obvious examples here are just like Peloton, Tonal, Tempo, like pick your favorite home fitness platform. And these companies are doing amazing, especially in the times of COVID. And the idea is that you buy the device and they do make money on the device up front, but that really where they're making their money is they're making their money and the access to fitness classes and personal trainers and fitness programs. And then there's examples like Dropcam, Ring, Nest, where you buy the device and then you're paying monthly if you want more storage, you want more cloud storage, you want better AI features, you want facial recognition, you can pay more and unlock those things later. And those are not hardware features. They're services, they're software, they have nothing to do with the hardware itself, but you can pay and unlock those features over time. The enterprise example for this is fun. So I was at Square for a while, and at Square, we literally gave away the hardware. We did not charge, we would give the hardware away to businesses and we wouldn't charge them anything for it. And the idea is that the hardware was really just there as an enabler. It was there to get customers stuck on our platform so that we could then turn around and make money off credit card processing fees and off selling them all sorts of like software functionality later. So if they needed help doing inventory management, if they needed help with things like analytics, like those are all things we could upsell them on later, but the hardware was a means to getting them stuck on the platform. So what does the revenue curve for this look like? So hint is that it's no longer linear. Now all of a sudden it can be this growth curve and revenue curve can be exponential. I think about it from a marginal cost perspective, and with pure hardware or even with the hardware plus consumables business model, in order to make more money, I'm having to first manufacture and then sell a physical item. And then in this particular business model, when you're talking about hardware plus services or hardware plus software, once I've developed a software feature, the marginal cost of selling an additional one is effectively zero. I mean, I'm oversimplifying it a little bit, but once I've developed a software feature, it doesn't cost me anything to sell that feature to one additional user or a million additional users. Like, it's already done. I've already built it. It already works. So software is very different from hardware in that perspective. And what that means is, from a marginal cost perspective, like, this particular business model is great in that it can allow you to grow your revenue so much faster than the other two business models that we've already talked about. So that's a reason why a lot of people are focused on trying to fit their hardware businesses into a model like this these days. So the last big one that I'm going to talk about is hardware as a service. And hardware as a service is a newer, and I'd say right now it's a lot less common. So it's a less common business model. It is not the same at all as selling hardware plus services. Hardware as a service basically means that you do not pay upfront at all for the cost of the device. Instead, you're paying monthly, or you're paying like an annual subscription fee. It includes the use of the device. And oftentimes it will include things like repairs, maintenance, software updates, customer support, any extra support, or on-site hand holding that you need to debug something. The distinction here, and the important thing to note here, is that it means that you do not own the device itself. Like, hardware as a service, you do not own the hardware. You pay for it. You pay for the ability to use it, but you don't straight up own the hardware. This is becoming more and more common for enterprise hardware companies. So for companies that are selling hardware into other businesses, a lot of robotics companies are going this way. And I think that the reason is that the upfront cost to adopt the technology is really, really high. Especially when you're talking about some of these like advanced robotic systems. And for most customers, even for most big enterprise customers, that is a deterrent. That alone is a deterrent and a barrier to adoption. So it can be really difficult for them to get over that hurdle and to adopt the technology, because the upfront cost is just so high. By adopting hardware as a service as a business model, you're spreading out the cost from an accounting perspective, which makes it a lot more compelling, and it makes it a lot easier for them to adopt. So my advice here is make sure you understand how your customers like to pay for things. If they don't like big upfront payments and your solution would require a big upfront payment, like, this might be something that you want to explore. So there are different ways that this business model can play out. So for one example is we invested in a company called Tortuga that does, they build robots that go out and pick strawberries and harvest strawberries. So the reality of the situation is, if you think about the farmer out in the field, or the company that's like operating the farm, they don't want to own a robot. Like, that's not their thing. Like, that's so far outside of their depth and expertise that they don't want to pay upfront and own a robot. But they do want to get the efficiencies, and they do want the access to it. So sometimes they'll be able to pay, like, they might pay per hour worked, like per hour that the robot is out working in the fields. They might pay per pound of strawberries picked. They might pay a flat monthly fee for unlimited use of the robot, for it to be out working in the field like as much or as little as they want. But any of those ways that they pay, it's still hardware as a service, because fundamentally they do not own the robot. Like, they're not paying for and buying the robot up front. They're paying to use it. And that is hardware as a service. On the consumer side, I really I struggle to find examples of this. To be completely honest with you, on the consumer side, like, this model is really, really rare. And the couple of like stretch examples that I came up with that are shown here is the cable modem and cable box. So it's like a lot of people will not buy their own cable modem, but like you'll get it from AT&T or Comcast or whoever, and then you'll see just like one line item on your cable bill that is like $5 a month for the box. And then, sorry, can you guys still see my slides? Yep. Okay. So you're paying to use the hardware, but you do not own it outright. Like you do not own it outright. And then on the Apple side, they've started dabbling a little bit recently with the iPhone upgrade plan. So it's the idea that you like pay a fixed amount per month, and then every X number of months, I don't actually know how many it is. I think it's like 12 or 18. Like you can choose to get a new phone. You do not own the phone outright. You end the contract, you have to return it. But it's the idea of like not being forced to pay for the entire amount up front and not being forced to own the hardware. The joke here is that hardware as a service is a fancy new terminology that that people are using in place of leasing. And the basic premise here is that like leasing is actually pretty similar to hardware as a service, which is different from financing. Like financing is very different. So financing is I still am buying the product, like I'm still owning the product, but instead of paying up front, I'm paying for it in installments over time. Hardware as a service is I do not own the product. Instead, I'm paying for the ability to use it. So one question that I get and that we debate a lot internally is why don't we see this on the consumer side? Like, why doesn't this exist on the consumer side? Why are all the robotics companies going this way? Why are enterprise hardware companies going this way? And why do you not see it on the consumer side? And one thing is like cost of consumer products is just typically lower. There's less upfront cost. And another theory I have is that people value ownership of physical products. When you're talking about physical products, it almost feels weird to me, and I'm curious how other people feel, but it almost feels weird to me to have a physical product and not own it. I think cars are probably the major exception to that. Like it is popular to lease cars, but I think outside of cars, it's pretty rare for consumers to be comfortable owning and using products that are having and using products that they do not actually own. So that kind of wraps up the four main categories of business models that I wanted to walk through. So now what I'm going to do is I'm going to walk through what investors like to see. Like which of these business models do investors consider good, bad, indifferent, and why? What do we want to focus on? So before doing that, I think it makes sense to have a little bit of context on how VCs work and how they operate.
Hey, Chrissy, this is Brady. I don't know if you can see it. The slides are rendering a little weird, so you might have to explain a little bit more on that pie chart, for instance.
Got it. That is so strange. I don't know why it's doing that. It looks totally fine on my screen, I promise.
Certainly the software issue. It's not a hardware problem. That's certain.
Would you like me to, here, let me see if this will help. Okay.
That's
Does
fixed.
that work?
Yep.
Okay. That's weird. I just went back and advanced again. So we'll see. Brady, call me out on it if it happens again, and I'll see what I can do to play around with it and fix it. So just to give like a really quick primer on how venture capitalists operate and how we make money. And this is a little bit of insider baseball, but the basic premise is that like we have a fund. Out of this fund, I'm making up numbers here. This is not indicative of Root Ventures at all in any way, shape, or form. This is a hypothetical example. But out of this fund, let's say I'm going to invest in 20 companies. That means I get 20 shots on goal, 20 shots on goal to try to strike it rich and try to win big. Per historical statistics, there are always going to be exceptions. There's always going to be outliers, but per historical data across a large number of firms analyzed, 10 of those 20 investments that I make are just going to flat out fail. They're going to return zero. I'm not going to get a penny back. Like, the companies are going to fold. 9 of those 20 are going to do okay-ish. Like, they'll probably sell to another company. I'll probably get my money back, maybe a little bit more than my money back, but not a lot more. And only 1 of the 20 companies that I invest in is going to be what I consider a success. And what that means is that my one big winner, my one successful company, has to be really big, has to be a huge success in order for me to make up and cover for all those 19 losses and from all the other failures. So in order to make real money, I need to have that one success be hugely successful, be worth tens of billions of dollars, be an IPO event. VC is all about, it's all a game of outliers. So I'm really banking on that one company to be really, really huge. And for better or for worse, this means that venture capitalists tend to encourage companies to grow as fast as they possibly can. If a company is going to fail, I want them to fail fast. VCs want big winners to bubble to the top as fast as they possibly can. They want companies that are going to fail to bubble to the bottom as fast as they possibly can, so that they know which companies they should spend their time and energy and their money on. So how does this relate to hardware business models? Like, how does this tie back to like the 4 business models that we talked about?
Hey, Chrissy, can you do the slide thing again? Yep. Oh, it's still doing it.
Huh. That's so weird. You can't even see. Huh.
Oh, well, guess we'll go with it.
All right. Sorry, guys. Yeah, so I'll just talk through what this slide is supposed to show. So the idea is that pure hardware companies, like, they're not growing fast. They're by definition, like, that growth curve that we looked at is linear. So to make an additional dollar, how I talked about before, to make an additional dollar, I have to build and ship an additional product, and that takes time and money. Investors do not like this. So on the consumer side, investors do not like this. On the enterprise side, investors do not like this. You will be very hard pressed to find any venture capitalist these days that will get excited about a pure hardware business model. Occasionally, you might be able to find an angel investor, like somebody who's investing their own money, that can get excited about this type of business model. But for institutional investors and venture capitalists, like people like myself who are investing other people's money, like, we will not touch those companies with a 10-foot pole. If that's your only plan of generating revenue is to sell a pure hardware product, like, that is not a business model that works well with what VCs want to see. On the consumable side, so it's hard to see, but like, there should be 2 question marks here. On the consumable side, consumables have faster growth. It's kind of a middle ground. It's some investors will take a look at companies that are consumable companies. Other investors won't. My advice with this one is, if this is your business model and you're out pitching investors, it helps if they have invested in a business before that has had some success with hardware plus consumables. So know your audience, know the companies that they've invested in. And if this is the sort of business model that they've invested in before, then it might actually be a very good fit. And you still can't see that at all, can you? So hardware and services, the row here is supposed to have 2 big green check marks in it. And the short of the story is that this is the best. Like, this is what you want to be pitching. This is what investors want to see. And it's just the idea that like, I'm selling hardware. I'm selling a hardware device and I'm making money off that hardware device, but I'm also selling software and I'm also selling services to be used with that hardware. Once I have built a new software feature, there's no marginal cost to me selling it to another customer or another million customers. So I can scale and I can grow my revenue extremely fast. And that's the type of growth curve that venture capitalists and investors love to see. Like that is what gets us the most excited. And lastly, the last row is supposed to say hardware as a service. And then on the enterprise column, it's a check mark. I don't know if you can see that, but on the consumer column, it's an X. It's the idea is that in the enterprise world, especially in the robotics side, like hardware as a service is really trendy right now. And a lot of people are out pitching it. No investor will touch it on the consumer side. Nobody. And you know, the reason why it comes down to working capital. So if I'm an early stage startup, I don't have a lot of money in the bank, and I can't afford the upfront cost of making tens of thousands of devices or hundreds of thousands of devices and then sending it to customers and having them pay me slowly over time a monthly subscription fee. Like you would, as a startup, you would have to have a huge pile of money in the bank in order to be able to make that business model work. Which is why I think you don't see it a lot on the consumer side, and you definitely don't see it hardly at all on the startup consumer startup side. So sorry for all the technical glitches, but hopefully that gives you like a pretty decent idea. Hopefully you can still read the slides enough that'll give you like a decent idea of what VCs want to see. But the last big point that I want to kind of emphasize, that I want to leave you with, is that there are lots of ways to fund your startup that does not ever involve taking a single dollar from venture capitalists. You can go out and get grants. You can get small business loans. You can do crowdfunding. Just because your business model does not fit with the type of growth curve that venture capitalists want to see does not mean that your business is a bad idea. Like not in any way, shape, or form. Like you can still be wildly successful. You can still be wildly profitable and make a tremendous amount of money without ever taking a single dollar for VCs. So I don't want people to leave thinking that Chrissy doesn't like my business model, therefore my business is a bad idea. Just because it's not a good fit for what VCs want to invest in does not mean that it's a bad business, and does not mean that it's a bad idea. But if you do have an idea for a hardware business that does fit into one of these categories that VCs like, please, come talk to me. I'd love to hear it. You can find me on LinkedIn. You can get to me at Chrissy@root.vc. Like, would love to chat more about any ideas that people have. So that is all I got. Brady,
yes,
I'd love to hear any questions that people have.
Yeah, a lot of questions. Thank you, everybody, for submitting those. But yeah, you heard it here from a VC. You don't need to raise VC money. I really like what somebody said one time, that revenue is non-dilutive capital, and I really like that. So yeah, I'll just go through some of these. We only have about 9-10 minutes, so we're not going to get to everybody. But some of the ones that I really liked, one that came through from Andrew De Lorenzo, by the way, he said in the chat that he's looking for feedback on his product he's launching soon, TalkSocket. So everybody go take a look and see what you think. But he was curious, what Seattle companies have you invested in? And then to add on to that, is Root comfortable investing outside of the Bay?
Oh, totally. So we look at companies in regions outside of San Francisco all the time. The UW company that we invested in is called ThruWave. I don't know, several of you are probably pretty familiar with ThruWave and the founder, Matt Reynolds. But they're bringing X-ray like visibility into warehouses and fulfillment centers. It's a really cool product, and it's a really, really technical team. And then we've also invested in a company called Esper. And then we've got, I've got one other company, a sustainable seafood company called Wildtype, that some of their team members are based up in Seattle, but then there's others in the Bay Area as well. So we're always looking for companies from all over the place.
That's convenient, because we're always looking for investors.
Yeah, but it's interesting because the category of investors that are willing to look at hardware deals is a much smaller subset of all investors. And I think that like in the Seattle region, there's a handful, but there's not a huge group. It's a pretty small crowd.
Yeah, and I'm curious about that. I mean, is that because hardware's hard? Is that because most folks that find their way into VC got there via software and they just don't have as much comfort with hardware? Is it higher failure rates, just added complexity? What are your thoughts?
My take on that is that it can be harder to assess the risk. So VCs are all about trying to figure out what the risk is of an associated investment and make sure that that's commensurate with the amount of money and time and resources that they're putting into it. If you haven't been around the block on hardware, if you haven't shipped hardware products, if you haven't spent months and months at a time on manufacturing lines in Asia and worked out a bill of materials and know when it's bogus and when cost estimates are real, it can be really hard as an investor to assess what the risk is associated with those companies. So I think most of the hardware investors are people that have either A, done it before, or B, have been investing in it for so long that they can pattern match and they can recognize and they can call bullshit when a schedule is nowhere near what it should be and it's going to take you 2 years longer to ship, or if you say your BOM cost is going to be $100 but realistically it's going to be more like $500. And if you don't live and breathe that day in and day out, it can be very, very hard to assess, sure. which makes it intimidating to invest in if you haven't done it enough.
I imagine. Question from Mike Lopez at Out of the Box, which is another great person to meet if anybody doesn't know Mike. He was asking kind of about how the investment space looks during COVID. I mean, are deals getting done? Are you guys active? Do you have feelings around, kind of the macro trends? I mean, is everybody cutting checks or check sizes down?
Yep. So it's been really interesting to watch this play out. When COVID first hit back in the spring, I want to say there was like a solid 4 to 6 weeks that investing kind of just ground to a halt, and most people in the industry weren't making new investments. Everybody was really nervous about what was going to happen and what the economy was going to do. And then and valuations tanked. Like companies were getting worse valuations and we're not getting as many offers. And that rebounded so fast. And now investors are hungry. People are writing checks, valuations are back up to where they were, or if not a little bit higher than where they were before.
Wow.
The pace of investment has picked up. Capital is pretty free flowing right now. Now it's actually a good time to be going out and pitching. But I think at the same time, there's also a lot of, we've done 3 or 4 investments in the past few months. So our investment pace has been right at where we want it to be. We've been very actively seeking out new companies and investing through this whole thing. But there's also a lot of uncertainty about what is going to happen in the future. So I think that everybody's actively investing now and leaning in pretty hard right now. Sure. But I cannot make any guarantees about what the world is going to look like 6 months from now or 9 months from now, and what the investing climate is going to be like then.
Yeah, I'm curious, just personally, if you think, is this changing things for LPs and raising new funds, or are folks trying to get their money into safer spaces, or are folks looking at, are you guys raising any funds, or were you planning on raising funds, or has this changed any of your plans?
It hasn't really changed our plans, but that's at Root Ventures, it's really a function of where you are in your fund deployment cycle. So venture capitalists typically go out and raise new funds every 3 to 4 years, roughly. And we got very fortunate and very lucky that we had completed our fundraise, I forget it, a year and a half or 2 years ago. And we are right in the middle of deploying the fund. So we still have plenty of fund left to deploy, plenty of new investments to make out of the current fund before we have to go out and raise a new fund. And from the sense of other people that are out raising, yes, LPs are changing investment strategies. It can be a little bit harder for us to go out and raise money if we were to have to go out right now. But at the same time, it's now is not a terrible time to be out raising, whether you're a startup, out raising money for your company, or whether you're a VC out raising a new fund. Like, now is not a terrible time to be doing it. But everybody's kind of holding their breath to see what the next 6 months are going to bring.
We're switching into turbo mode because we are very nearly out of time. But from Jason, who I'm hoping is going to move to Seattle and start a bunch of new companies here, can you talk about what a typical investment looks like at Root, and what a typical raise looks like of a company that you see coming across your desk?
Yeah, absolutely. So we typically write $1 to $1.5 million checks into companies that are pretty early, that are just getting started. So we'll write $1 to $1.5 million. We'll take 10 to 15% ownership, and then a lot of times those companies will also syndicate around. So we'll bring in additional investors to participate. So they'll end up raising somewhere between $2 to $5 million total as part of their seed fundraise, and then we'll be taking a portion of that.
Perfect. Sharik asked, in hardware as a service, in the case of a necessary repair that happens, how do you qualify, or how should the companies qualify what would be customer negligence, so something that they should foot the bill for, versus a manufacturing issue, something that the company should foot the bill for?
Yeah, it's not always straightforward, and it varies so much from company to company as to like what is included and what they will cover and what they won't. It's the same thing with like my iPhone, right? It's like, what classifies as abuse, as excessive abuse, and what doesn't. When I'm always taking my phone into the Apple Store and holding my breath that they're gonna take it and fix it and not charge me for the repair. So there's no cut and dry answer. If you're a startup, most startups err on the side of absorbing the cost of maintenance and repairs. It's like, you want to do everything in your power to keep your customers happy and keep them coming back and wanting more. So you're going to always err on the side of being generous, and just even if they beat your robot to death, you've got to buy a bunch of like really expensive replacement parts because they were negligent. Like, a lot of times you'll still just eat the cost in order to keep them happy.
Great. I'm way too nice to my things, apparently, so I'll just play it fast and loose. Last question from Marco Micheletti, who is a speaker in the series.
Hi, Marco.
In the hardware as a service model, it implies that somebody is covering the upfront capital cost of the hardware. Do you see this capital coverage usually through a VC raise or through commercial financing? So I think that's a great question. If I'm making these, big printers and I let you rent them from me, that money has to come from somewhere. Where should that money come from?
Very good question. It's typically debt financing. So a lot of times startup companies will go out and they will raise a VC round, and the VC money is intended to fuel the growth of the company. But then if you have to front, you're doing hardware as a service, and you have to pay for the manufacturing and assembly and deployment of your first 100 robots or your first 1,000 robots or whatever, you typically will not dip into your VC fundraise in order to do that. You'll go out to a bank and you'll secure what we call debt financing, which is basically just a loan on fairly favorable terms from that bank in order to be able to finance it and fund the assembly of those.
So are we thinking like Silicon Valley Bank types? I'm assuming not Bank of America.
Most of our portfolio companies that have gone out and taken on debt financing recently have gone through Silicon Valley Bank.
Okay.
They know the drill. They work with startups all the time. It's very common. The terms are pretty standard in terms of what you can get and what they'll offer you. So SVB is the popular choice these days.
Great. Well, I'm getting yelled at because we're late. So everybody, thank you. That's all we have time for. This is one of our best attended virtual events we've done. It seems like there's a hunger for hardware programming, and we're going to be happy to keep bringing that to you. Really appreciate the questions. It's a lot of fun when we get to answer as many as we can. Sorry that we didn't get to everybody. And a big thank you to Chrissy for sharing your wisdom and coming on here. And also just personally, you've been so helpful as we've tried to get this thing off the ground. You've had so much guidance for us, and I really appreciate that.
My pleasure.
Also, big thank you to Hans for co-hosting the event. Please do make sure to join Hans's meetup group. The URL is going to be up on the screen right now. They have great programs as well. I've learned a lot from joining that group. As a reminder, next week we'll be hearing from Scott Heimendinger, an entrepreneur and inventor who is working at the intersection of food and technology. He'll present how to start prototyping your next smart hardware product. So sign up for that at the URL, and we will see you next week. Thank you all for joining. Feel free to please reach out to me if you have any questions or just want to chat, and thanks for attending.